I think it's going to be a very, very good year for precious metals investors. I think that safety is going to lead to prosperity, and it's going to happen over the next couple of years, and I'm going to be showing you that in a little while. For the past couple of years, New Year's is when I sort of make some predictions on what I think might happen in the coming years. And for this year, I think that we're finally at this place that I have been preparing for now since 2002. I have been getting ready for what I think is about to come. Just as a reminder, this is a performance comparison between the S&P 500 and gold. And so for this century, from the year 2000 until now, the precious metals have been the best performing asset class other than cryptocurrencies, which came out in 2008 is when Satoshi Nakamoto introduced Bitcoin. And so that's a relatively new event, and there are great percentage gains to be made when you're coming off of zero. But cryptocurrencies right now are down quite a bit. A lot of people are sitting on significant losses if they got into it since Bitcoin peaked in last December. So over the last year, 2018 was a very bad year for cryptocurrencies in general. And so I do own some cryptocurrencies, some that I've got profits on and some that I'm sitting on losses. But when things are down, that's the time to accumulate. But I think precious metals investors are going to have a lot to celebrate in the coming year. So this is the S&P 500, and you can see that it from the year 2000 until 2018, that it pretty much doubled. But on the way there, investors had to take this wild roller coaster ride sitting on these enormous losses. And if you were smart enough to sell your stocks at the peak in 2007 or sell your gold at this peak in 2008, and then buy back into the stock market, right at the bottom after the Lehman collapse and the global financial crisis, right at the bottom in 2008, then you would have done better than gold. But you know what? I'm not that smart. I can measure the beginning of a bull market, like the secular bull market that began here in gold. I could tell you that gold was 1/45th of the Dow, that it was extremely undervalued. The gold real estate ratio was extremely out of whack. But right here, PE ratios were insane. I could tell you that the stock market was in a bubble. And I did, and a lot of people did get out of it and get into gold because of me. A lot of people got out of real estate and into gold because of me, and then real estate crashed right after that. But I could tell you that the stock market was in a bubble because of PE ratios and dividend yields and other various ways of measuring its value. But here, this trying to get back into stocks at this bottom here, stocks, the PE ratios had fallen down almost to fair value. They had fallen from bubble territory into the extremely overvalued area, and then they just touched fair value and bounced back off into extremely overvalued and back into a bubble. And today we're once again in hyper bubble territory with stocks. So what would it look like if you were that smart and you could somehow magically predict that bottom would come right there? Well, you would have done a lot better in stocks than in gold. But the reason I show you this chart, stocks would have given you this great return. First of all, we've got this really ugly top going on here in the stock market, and I think that the top is in. I think that what I have been waiting for and investing toward for the last 15 years is finally here. But what I want to show you is, even though the stock market made these incredible gains during this period of time, gold held its own. It just sort of noodled sideways when it should have been falling. This type of rise in the stock market should have pushed gold below $1,000, and it didn't. And the reason that it didn't, I believe, is because China and Russia have been buying up so much of the world's gold production, getting prepared for whatever is coming. Now, there was a period here where gold and the stock market rose simultaneously, and that is because of the fear that was left over from the 2008 crisis, propelling gold up into its peak in 2011. Now I want to show you gold measured in Australian dollars. Our Aussie friends have something to celebrate. This does not contain intraday information. If it did, you would see gold has been setting all-time historic highs measured in Australian dollars. So this is a function of exchange rates. The reason that gold noodled sideways all of this time is because the dollar was rising. Gold measured in many other currencies is setting all-time highs. Now I want to go back to the stock market and sort of try and predict what may lie ahead in the future for stock market investors. We've got this really ugly sort of double top here, and these pullbacks that happened in 2018, and then the crash after Jerome Powell, chairman of the Fed, announced the last rate increase, that they were going to stick with these rate increases, and basically he sacrificed the stock market to support bonds and the U.S. dollar. If he had not done the rate increases, then the U.S. dollar and bonds would have started to crater, and the stock market may have kept on going higher. They're stuck in a corner, and they have to make some very tough choices, and it's basically one or the other, and they chose U.S. Treasuries and the dollar over the stock market. So the stock market has made this little crash. Where would it go from here? I mean, just eyeing this thing, you can see a big support zone where there was a whole lot of trading going on in 2015 and 16 in this area. There's a lot of buyers and sellers right in there. And so that's sort of a logical place for it to come down and then bounce. There's also support from this minimum right here, this little dip. Those tend to be support zones. And then there's really nothing in here that becomes support until you get back to the previous highs of the stock market in the year 2000 and 2007, the double top that happened there. But I want you to notice something. It sort of rises and then puts in a double top here, and then when it falls and crashes, it rallies up somewhere into where these previous dips were. And then we've got a double top here, and it crashed, and it rallied up right to where that dip is. Well, I want to introduce you to somebody now. His name is Fibonacci. And in the year 1202, he wrote a very important paper, a math paper, that introduced the Arabic numeral system to Europe. We had been using the Roman numeral system, which makes math incredibly difficult and makes the calculation of interest practically impossible. When Fibonacci introduced the Arabic numeral system 1, 2, 3, 4, 5, 6, 7, 8, 9 to Europe, suddenly banking, finance, and math became much, much easier. But in that same paper, he also introduced something that we now call the Fibonacci sequence. You've probably seen this beautiful pattern before that is created by the Fibonacci sequence. And this occurs all over nature. You see it in the way plants grow. This is a pattern that was created using the Fibonacci sequence. You see it in the nautilus shell. It's just an absolutely beautiful thing that occurs throughout nature. And here's something that I have to introduce here. Humans are a part of nature, and we have herding patterns. Here, gravitational pull is what's causing these spiral arms in a galaxy, and the gravitational pull follows Fibonacci sequence. Now I want to get back to the stock market. And, on stock charts where I generated these charts, there's a tool for introducing what are called Fibonacci retracements. And so this is when you put a Fibonacci retracement on it, those visual things that I picked out as far as areas where the stock market should bounce, the support zones, it just fell right on top of those. And I didn't do this until today. And I was just astounded. I had looked at the stock market first and I said, well, where is it going to fall to? Where will it make some bounces on the way down? And the first one here is in this big support zone, and then you've got that dip, and then you've got the previous peaks of the stock market. And so if I were to take a wild, what I call swagging it stands for scientific wild ass guess. So if we're going to swag it a little bit, let's add some bounces here. Remember that when the stock market made a double top, it crashed and then rallied up to the resistance of the little crash that was in the middle. We've had a number of little crashes in 2018, and so you've got to take this area of the crash before Jerome Powell introduced said that he was going to raise interest rates and cause the stock market to crash. And so somewhere in this area, I'm expecting for the first couple of weeks or months of 2018 that we're going to rally a little bit and come back up into this resistance area, but probably make a lower high. And then we'll have a crash that goes down to the 38.2% retracement and this support zone. And a lot of the media will be saying, hooray, the crash is over, time to get back into stocks, and it'll rally up until it encounters the resistance of the crash that we've already experienced. Remember, we've bounced off of this low already. So we're already on our way up in this rally that I'm predicting for the first couple of months. But once that's over, crash down to this 38.2% resistance, a rally back up to this now, and then another crash. Now, this support at 50% is sort of weak. There's not a whole lot, back over here. It's just this one little dip. So it might just blow right through that. I have no idea. But it may bounce off of that. If it does, it'll probably rally back up to this the support that will become resistance at that point. And then it'll be down to the 61.8 or 62% retracement just to round it off. But that's huge. 62% of all the gains made since March of 2009 into 2018 will be wiped out during this event. And you know what? I think that is one of the better scenarios. Now, it's possible that something could get announced where the stock markets rally and we do set new highs, but I think it is highly unlikely. This is one of the longest bull markets for the stock market on record, and it's old in the tooth. We created some tax cuts that have goosed the economy and pumped this a little longer than it should have gone. And those tax cuts were already factored in to the stock markets when they were passed early in 2018. So this little blow-off top that was happening here, this was the anticipation of the tax cuts. So I think that this is actually one of the better scenarios. But if we have a really bad recession or mini depression, I think that this is entirely a possibility. And the worst case scenario is this. This would be what would happen if we really go into a full-blown crisis / potentially depression because of all the manipulation that they did to this market. I believe that the bottom is in. The bottom was back in late 2015, and that we're on the way up. I don't know if we're going to get this one last pullback. I have some cash set aside to buy a little bit more precious metals. Now this is, and I've covered this many, many times, and this price target keeps on changing. But if history were to repeat, and this is the value of the gold at the Treasury, so it's the number of ounces times the price of gold, and this is the quantity of base currency that exists, the dollar value of all the paper dollars and deposits at the Federal Reserve that exist. And twice during the last century, the value of the gold at the Treasury has risen to meet or exceed the value of all of the base currency that exists. Here, it is the free market and the will of the public doing this, and it way overshot back in 1980. This is January of 1980. But what I show here, this spread is larger. The opportunity between this, if history were to repeat, and I believe that is what's happening, as history is repeating, this is the bull market of the 70s. Gold went from 35 to 200 to 100 to 850. And this mid-cycle correction is what we've been in. This is just a long, protracted, drawn-out version of what has happened in the 70s. And you're going to see this go up and meet this because of the enormous amount of panic that is going to happen during this horrific crash that is the result of the Federal Reserve and the world central banks trying to manipulate everything. The Keynesians are wrong. Keynesian economics does not work. The free market always overwhelms their manipulations, and the problem with that is the energy from warping the economy. When they push one sector or another sector into a bubble, the economy is warped. The free market tries to straighten all that out, and when it does, it punishes anybody for manipulating the economy, and I really do think you're going to see something horrific. Now, one of the other things I measured, this was one of the premises of my book, Guide to Investing in Gold and Silver. Since credit cards were created back here, Diners Club was the first one in the late 50s, and then American Express. Credit currency is very similar to base currency. It comes into existence, though, when you make a charge on the credit card, but the merchant that you're paying, their bank account can't tell the difference between cash or the credit currency that you created when you made that charge that's in circulation, and it stays in circulation until somebody saves it up and pays down credit card debt. So you have to add that to the currency supply. And if you do, if history were to repeat and the value of the gold at the Treasury rises, so it's the number of ounces they've got, which is now static, times the price. Here, it's the ounces that are changing, and the price is static. It was $20.67 an ounce, and then the price went to $35 an ounce, and this is the number of ounces changing. Then the number of ounces becomes static, and it's the price of gold changing that causes the value of the gold at the Treasury to rise. And for it to rise to cover the currency supply plus outstanding revolving credit like it did in 1980, that requires $18,000 per ounce gold today. This is a moving target. I'm not guaranteeing it, but what I can tell you is that there's going to come, just like in 1980, when gold hit $400 an ounce in November of 1979, in 1971 it was $35 an ounce. So just 8 years earlier. And investors thought that $400 was a ridiculous price for gold. And so when they'd go in to buy gold at some coin shop or something, and back then the average person didn't make very much. So you're making $15,000 a year. You've got $1,000 in your bank account. You draw out $500, and you go into a coin shop and you say, "I want to buy gold," and they drop one coin in your hand. But the reaction was, "Well, how much is the silver?" Well, you can get 35 of those or 50 of those for the same price. And that's when the public says, "Well, I want the silver." And that's when things turn around for silver, and silver takes off like a rocket. So that is probably going to happen at around $5,000 per ounce gold, I believe. That's the point where people will say, "Wow, in the year 2000, gold was only $250 an ounce, and now it's $5,000. So I believe that $5,000 is a stupid cheap price for gold, that it is absolutely going there. And here's another way of measuring it. This is the amount of gold at the Treasury divided into the currency supply. So the amount of gold at the Treasury divided into the currency supply. When the value of gold at the Treasury exceeds the value of all the base currency, then gold is expensive. When the value of gold at the Treasury is less than base currency, then gold is cheap. And when it's down here, it's very, very cheap. And here's the data. And you see This was actually unpegging gold for a day and then repegging it. We were on a gold standard. So they'd unpeg it from the US dollar and then repeg it. And over a month and a half, exchange rates changed. So it's really the free market revaluing gold. Went up to $35 an ounce, and it matched the size of the currency supply. And then it exceeded the currency supply for a while. And then this is 1980. And right now, gold is on sale. It's like almost the cheapest it has ever been. And John Williams at ShadowStats agrees. When you use the pre-Ronald Reagan, the pre-1980 Consumer Price Index, you use that method of calculating inflation, and you inflation adjust gold, it's at a 300-year low right now. So this is information from John Williams at shadowstats.com, Shadow Government Statistics. Now, the last chart in this whole presentation, I haven't talked about silver much because gold is an economic indicator. And this whole presentation has been about the economy. Silver is not an economic indicator until people start rushing back into silver. Gold always has some monetary demand. Right now, silver has no monetary demand, but it's going to get monetary demand. The world's central banks hold gold as an asset, and they've been increasing their gold holdings pretty dramatically, especially countries like China and Russia, where they know something is coming and they're getting ready for it. But silver doesn't have any monetary demand yet, except for a few investors that are trying to protect themselves and they believe in silver, but it's a very small amount. So this is the sources of mine production, and only 30% of all the silver produced comes from silver producers. The rest is just a byproduct of all these. Now, in a global financial crisis, you're not going to have much copper dug up because the real estate booms that have been going on all over the planet, they're not going to be needing more copper plumbing and more copper wire. And so the amount of production of copper is going to drop dramatically, probably by more than half. Lead and zinc. These are things like car batteries and zinc castings for cars and so on. That automotive production is going to fall dramatically, and you're going to see this production go down. So you're left with about 40% of the production, and if this 60% falls by half, there's a whole lot of silver production that is going to vanish just when the public is rushing into silver. This is the end of my presentation, but I really do think that gold and silver are finally going into this last up leg. I don't want to see it, but, I can't correct this stupidity of politicians. I can't get them to do what I think is correct, what I know is correct from an Austrian economics point of view, and I can't control the world's central banks. I've often said that gold and silver come with a central bank guarantee, and the guarantee is that they will never stop printing the currency that gold and silver are measured in. So when you're printing currency that measures real money, eventually that real money has to catch up and probably exceed that currency. And that is what's going to happen over the next few years. There's going to be a crisis. You're going to see gold and silver gain many, many times in absolute purchasing power. So that's about it for this presentation. I want to thank everybody for watching. Hopefully, you all protect yourselves. You've got to make up your own mind. Nothing in here is financial advice. I'm just showing you, this is the reason that I have been protecting myself with gold and silver. Even during the pullback that we've had since 2011, I've been accumulating during all of that. I've been accumulating gold and silver since 2002.